alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief.
Good morning, everyone. Stock futures holding on to gains, and the 10-year Treasury yield falling despite another surprise on inflation. Core PCE coming in slightly higher than expected at 2.8%. The move in early trading showing traders were already positioned for perhaps another hot print.
And Alphabet and Microsoft really driving tech higher this morning. The gains coming after both tech giants impressed the street with their quarterly reports, showing that AI spending is paying off. So let's get right to it. The three things that you need to know, your roadmap for the trading day. Yahoo Finance's Jen Schomburger, Jared Blickery, and Ines Ferre have more.
Futures hanging on to gains even as the Federal Reserve's preferred inflation gauge clocked in hotter than expected last month, underscoring it will take longer for the Fed to gain confidence that inflation is dropping before cutting interest rates. Fed Chair Powell warned ahead of this number last week, saying that he didn't expect it would show progress and said it would take longer to gain confidence inflation is dropping.
Plus, big tech earnings sending Nasdaq futures higher this morning. Spending on AI and cloud computing is paying off for both Alphabet and Microsoft. Shares of Alphabet jumping after the company reaffirmed its commitment to investing in AI and authorized its first ever cash dividend program and $70 billion buyback. Microsoft is also climbing higher this morning on strong AI demand powering growth in its cloud products.
Meanwhile, the energy sector seeing some pressure this morning. ExxonMobil and Chevron reporting mixed earnings and profit declines in the first quarter. The two energy giants seeing revenue fall 4% from a year ago on lower refining margins.
Today's top story, that March PCE inflation print coming in line with expectations on a monthly basis, but year over year, just a hair hotter than expected. Here with what this reading could mean for the Fed's path towards their next meeting and the pathway forward here. We've got our very own Jennifer Schonberger. Hey, Jennifer.
Good morning, Brad, and happy Friday. That's right, a new reading on the Federal Reserve's preferred inflation gauge showing that prices remained elevated last month, underscoring concerns that inflation is going to take slower and longer to drop and that the Fed won't be cutting rates anytime soon. Take a look at that number, the so-called core personal expenditures consumption index, which excludes volatile food and energy prices, that clocked in at 2.8% for the month of March, holding the same level as February and 0.1% higher than expected year over year. This coming after we got a reading on first quarter GDP that showed that inflation did remain elevated in the first quarter. Fed Chair Powell warned ahead of this number last week that he didn't expect it would show progress. The Fed Chair signaling it will likely take longer to cut rates following that hot reading on the consumer price index for the third month in a row, when he said that it will take longer than expected to achieve confidence that inflation is coming back down to the Fed's 2% target. Taking a look at Fed funds futures this morning, measured by the CME, investors still pricing in only about a 45% chance that the Fed will begin cutting rates in September. Guys?
All right, Jen, thanks so much there. All right, well, futures are higher as March PCE inflation comes in pretty much in line with expectations. The Nasdaq getting a boost on the back of AI-fueled rallies from both Microsoft and Alphabet. So let's take a look at where we are here today. Just about 27 minutes here until the opening bell. So we are looking at gains here, at least for the Dow futures. That pointing to a gain of just about 53 at the open. Taking a look at the Nasdaq 100, some of the as we scroll down to the futures action here, that is also pointing to gains here, up just about 1% here in early action, as well as the S&P 500. That's also moving to the upside there, moving further above that 5,100 level. And I think this is a bit surprising, maybe when you take a look at the fact that that headline number, 2.8% on core PCE, coming in a bit hotter than expected. But I think when you take a look at the broader market action, what we're seeing, a lot of that had already been priced in from previous days' moves. And that's really why we're not seeing a bigger reaction, I think, in futures trading today. Yeah, and you mentioned tech. That's one area that we're going to dive into just a little bit more in a hot second. But let's tee up that discussion here with a heat map of the Nasdaq 100 here for you on this Friday. And every day we'll give you a look at the heat maps for the Nasdaq 100. But anyway, taking a look at some of those pre-market moves, take a look no further than, there we go, Alphabet, Google, Alpha Google, whatever you call them,
call them up by about 12% here pre-market as well.
Huge moves here to the upside. All right, well, inflation showing little sign of slowing in March. The PCE price index rising to 2.8% compared to last year, coming in slightly hotter than anticipated. The data solidifying traders' expectations for September cuts. To break this all down, we have Brian Rose, UBS Global Wealth Management's U.S. senior economist here. It's great to talk to you. So talk to us just about how you're looking at this print and what this overall means for the Fed here, do you think, in the coming months?
Sure. So the recent inflation data has been too high for the Fed to think about cutting rates, but it's not that far out of what the Fed was expecting. So if you go back to the March FOMC and the dot plot, the Fed was saying we're going to cut rates 3 times by the end of the year, and we're looking for the core PCE inflation to be at 2.6 at the end of the year. And in March, we were at 2.8. So it's not a huge difference. We just need inflation to come down a little bit, and then the Fed can think about cutting rates.
Certainly. And as you look across some of the indexes here within this broader report here, is there anywhere that you think the Fed does not have a lever that it can pull in order to bring down inflation in some of the stickier areas? Namely, it's been, especially as we think back to what the CPI and that hotter than expected read was, it's been shelter, it's been energy costs. And so how does that pair with this PCE report for you?
Yeah, I'd say the big problem for the Fed isn't those things. They're very confident that shelter inflation will slow because we have more timely data on rents, which is clearly showing that shelter inflation will head down. The big problem for the Fed has been core services excluding shelter. These are the things that are most closely linked to the strength of demand and also to wage growth. And this is where, the Fed's been talking about this for 2 years. This is where they want to see disinflation, and the readings are just too hot. So the good news for the Fed, though, is that wage growth is slowing. So that does imply that this category of inflation should slow over the medium term. And again, in our view, we're not that far away from circumstances that would let the Fed start cutting rates.
So, Brian, what does that timing then look like, do you think?
So our base case is September. Of course, earlier we were talking about June, but because of the higher inflation prints we've had so far this year, we've pushed that back to September. There are risks that if we continue to get the sort of inflation prints we've had recently, it could get pushed back even further. But again, you look at things like the wage growth, which is clearly trending lower, and also we had the GDP coming in below trend in the first quarter. Slower economic growth would also help to get inflation down. So, we're optimistic that we will get inflation prints similar to what we got in the second half of last year. And, that's good enough for the Fed to start cutting by September.
Yeah, you mentioned wages. We're going to get a trove of economic data on the employment front next week as well. What are you anticipating, especially as we're looking to see which industries are adding the most jobs, but at the same time, the pay that comes along with those jobs that are being added in industries that are still trying to rebound?
All right. So from the Fed's perspective, they don't have a mandate on growth or payroll growth. What they really are interested in is the balance between supply and demand in the labor market. And the ultimate measure of that for the Fed is wage growth. And so because of the situation where we have lots of immigrant labor coming in, it's a bit hard to gauge what is a sustainable pace of payroll growth right at the moment. So the Fed's really focused on wages. And again, you clearly see in all of the wage measures that things are slowing. Also, when the Fed contacts its businesses across the country, they put that information in the beige book, also clearly showing less pressure on wages. So, the Fed is mostly concerned about the medium-term outlook for inflation. Where's inflation going to be 2025, 2026? They're not that, worried about, the monthly prints. As long as the outlook is for inflation to slow towards the target, again, say by the end of 2026, That's what they want to see before they start cutting rates. And wages, I would say, are a very, very important component of that.
Brian Rose, UBS Global Wealth Management, U.S. Senior Economist. Brian, thanks so much for taking the time here this morning. I appreciate it.
Thanks very much.
Certainly. Well, two more Mag 7 stocks making big moves this morning. Alphabet and Microsoft both climbing higher after reporting results that showed their big bets on artificial intelligence are paying off. Alphabet reporting first quarter ad revenue rose 13% and cloud revenue jumped nearly 30% from a year ago. Alphabet CEO Sundar Pichai touting the company's investment in AI and technical innovation on the earnings call. Take a listen to this.
We are committed to making the investments required to keep us at the leading edge in technical infrastructure. You can see that from the increases in our capital expenditures. This will fuel growth in cloud, help us push the frontiers of AI models, and enable innovation across our services, especially in search.
For more on these results, Ted Mortensen, Baird Technology Desk Sector Strategist, and Rishi Jaluria, who is the RBC Capital Markets Software Equity Analyst, join us now. Gentlemen, thanks so much for kicking off and kind of ahead of today's trading session with us. We got to break this down, and we just heard from Google or Alphabet, so we'll start there with what Sundar Pichai had to say. Rishi, I want to go to you first. I mean, you hear these comments on the earnings call. How does that change your thesis, your way of thinking around this name, and your own kind of rating that you have on it?
Yeah, absolutely. And remember, I cover Microsoft, so I can kind of talk about that and then maybe more broadly on AI. But look, the commentary out of both Google and Microsoft, I think, tells us that there is real demand for AI. And, it's happening kind of at the data and infrastructure layer for right now. But what's really happening is there's actual money being put behind this. It's not just hype. It's not just, people talking about it. There's actual capital being put to work. Look at, Microsoft, where they said about 7% of growth from Azure came from AI. That implies that AI is already a $4 billion ARR business for Microsoft today. And that's not even counting any benefits that we're going to see from Office Copilot. So really, I think this is just speaking to the fact that although it is very early days for generative AI, there is real interest and real capital being put to work with this.
Ted, what do you think? Do you agree that this AI narrative now is back on track and back in favor for investors following these two results?
First of all, thanks for having me, and I do agree with your guest. We are going through really a generational infrastructure build with right now a lot of semiconductors, a lot of hardware, a lot of networking as that Gen AI stack gets built out. So we're seeing these CapEx numbers. If you look at where Google spent this last print, it was $12 billion. Microsoft CapEx was $14 billion. They are spending a ton of money on infrastructure. And what gives them both the advantage is their data center footprint already exists. And their internal expertise in generative AI, they're hitting it from a little bit different tax with Microsoft investing in OpenAI. And Google has a lot of internal Gen AI through DeepMind. So both are juggernauts, and this market's just starting right now on the infrastructure side, and soon will translate in the software layer, probably in 25 on the enterprise side.
Rishi, how soon do some of the capital expenditures that both of these companies, but specifically in the company that you cover in Microsoft, and excuse my Friday slip earlier as well, in the company that you cover, how quickly does this need to pay off for them in order for investors to really remain confident?
I think Microsoft is in a very unique situation. The fact that they have real AI revenue today, right, going back to that $4 billion ARR number. And one comment that I'm sure you may have caught that Satya was talking about on the call yesterday is there's not even enough capacity to meet demand. And it's not just GPUs and server capacity. It's literally things like power and cooling that there's just not enough of. So I think as long as that AI number continues to tick up, as long as you start to see evidence of things like Office Copilot actually tracking ahead of E3 and E5, I think investors will be patient with that CapEx number. And that's why, Microsoft stock isn't being punished on these high CapEx numbers, because there's the demand to back it up. If there was not that demand, or if demand started to be light, then I think investors would start to question those CapEx investments.
And Ted, I'm curious to get your thoughts on that, because it was very interesting. I guess you could make the argument that maybe Microsoft and Google, Alphabet really forecasted it better than Meta did. But Ted, why do you think we saw such a different reaction to Meta's results when they were talking about CapEx and the spending that they're doing there versus what we're seeing from Microsoft and Google, given the massive ramp that they have also put forward in investments in AI?
I think it's just a game of positioning. Meta was extremely crowded going into the print. There's some people that didn't look, that quite frankly didn't like some of the unprofitable spend. But Meta is almost to somewhat is very attractive down on where it got hit the last few days. I would say though that Microsoft has a huge advantage here just because of their enterprise footprint. And right now we're looking at roughly 5 major clouds that are going to consolidate this Gen AI macro. One thing that the investor community, though, does have a little bit of some heartburn with is if you look at enterprise spend on the IT side, we're up roughly about 3% per year. It's just not all a panacea out there. The Global 2000 has to find a return on invested capital that makes their gate that they can actually buy this Gen AI and make money. I think one of the near-term calls that was very interesting at the end of the call, the IBM CEO basically said, "Hey, listen, I've got my consulting revenues are a little bit under pressure because the Global 2000s are trying to find a ROI component to this Gen AI. They're not there yet. It's coming. It's just a matter of time before it arrives." As it relates to Meta, it is a juggernaut in AI, and with their LLM models coming forward, it should be watched very, very closely.
You know, Rishi, as we were looking through some of the elements and listening into the call as well, I mean, one of the huge things that jumps out specifically about Microsoft is the management and how this company is managing so many different arms of business, whether that be LinkedIn and the growth that they're expecting to see there. AI touches that, whether it's cloud and AI touches that. It seems like they're successfully weaving this narrative into it, but the pricing mechanism, how are they going to need to kind of put that forward into market continuously to make sure that there isn't churn off of some of these services that they've started to really introduce to their client base?
Yeah, I think it varies from product, but I think you're exactly right. Like with Microsoft, the strategy is to bring AI throughout the entire portfolio of products. And I think that goes to, Satya being a very forward-thinking, visionary CEO, and the fact that Microsoft has this relationship with OpenAI going back to 2019, years before any of us on this had heard of ChatGPT to begin with. From my perspective, I think Microsoft is going with the right monetization strategy, which is something like GitHub Copilot, where there's actual tangible benefits, right? Developers are really 30 to 40% more productive using that. You charge an amount that's a very easy to digest amount that I think that number will go up over time. Same with Office Copilot, right? It's being priced at a level that I think any enterprise, as long as it can get past the security and governance concerns, can start to use and say, this is worth it. Let's start to pay for it as long as the benefits are there. In other areas, I think they'll just give it away, right? Dynamics, I think they can use AI as a way to gain share from the incumbent CRM vendors. LinkedIn, I think there's ways to bring AI there to just get more user growth and more conversion of free to paid. So it really is going to vary from strategy, but ultimately, whether it's direct or indirect, AI will contribute real revenue. And even if we think about Office Copilot, if it can track anywhere close to like E5 adoption in the next 3 years, Office Copilot itself can be a multi-billion-dollar business. And that's assuming just a 2 to 3% penetration rate.
Ted Mortensen, Baird Technology Desk Sector Strategist, and Rishi Jaluria, who is the RBC Capital Market Software Equity Analyst. Thank you so much for taking the time here this morning. Really appreciate it, guys.
Thank you.
Thank you.
We're also watching 2 energy giants this morning, ExxonMobil and Chevron, both seeing profit decline in the first quarter. Both of these energy giants seeing revenue fall 4% from a year ago as a rise in oil prices fails to offset other headwinds in the energy space. Yahoo Finance's Inez Ferre has been all over this one and has the details for us. Hey, Inez.
Hey, Brad. Yeah, let's start with ExxonMobil. Mobil's adjusted earnings per share came in at $2.06, and that came in short of what some analysts had been expecting. Now, the company said that impacts from derivatives and non-cash charges contributed to lower earnings. Wall Street also noted a decline in the company's refining segment profit. However, the company's balance sheet, as one analyst put it, is extremely healthy. Meanwhile, Chevron's first quarter adjusted profit came in at $2.93 per share, beating Wall Street estimates, but that's still down roughly 17% from the same period last year, with Chevron saying that first quarter 2024 earnings decreased because of lower margins on refined product sales and lower natural gas realizations, partly offset by higher upstream sales volumes in the U.S. Now, natural gas prices have plummeted this past year, down roughly 34% year to date. The expectation for this quarter is that earnings will rise on a year-over-year basis. And not a lot of color was given, though, to the timeline for the arbitration on the Chevron Hess deal. Remember that ExxonMobil still says that it has a right of first refusal for the Guyana stake, which Chevron would be acquiring by buying Hess. And it's a big deal because Hess reported a 70% boost in production in Guyana this past quarter. ExxonMobil also saw record production in Guyana, so it's proving to be a very valuable asset, guys.
All right, Inez, thanks so much. Really appreciate that. Tracking XOM and CVX. Thanks.
Thank you.
Well, we're just getting started here on the Morning Brief. Coming up, Intel shares falling after the company fell short on the revenue outlook. We've got the details on that report, and later, CEO Pat Gelsinger will join us. That's an interview you do not want to miss. Plus, oh snap! Shares of Snap rallying this morning. The company beat estimates on the top and bottom line. We'll explain the company's new advertising efforts on the other side for the brand of Ghostface Chilla. And later in this economy, what kind of home can you own for $1 million? We've got the answers in Wealth. Stick around. You're watching Yahoo Finance. 11:20 a.m. Eastern Time. You do not want to miss it. Plus, let's talk a little Ghostface chill here on the day. Snap shares surging this morning, up 25% after reporting revenue jumped 21% in the first quarter from a year ago. They gave an upbeat outlook for the second quarter. The company also seeing daily active users climb 10% to 422 million. Okay, so a few things to really break down here. Number one, I mean, just this massive reaction here. And we've typically, over the past few quarters, seen some significant gap up, gap downs, depending upon a few factors, and especially the time spent on the platform and the number of people that are remaining and how they're growing out to that platform as well. And I think it's really just come with some of the investments that they've made technology-wise, whether it's AR or mixed reality, and then making it a platform that has more advertisers wanting to overflow over to it. I think there's another thing in TikTok. If you do see a massive or significant change in TikTok's ability to operate here in the US, Snap could be a beneficiary.
Exactly. We heard that from a number of Meta analysts over the last couple of days. You can make the same exact argument here for Snap. Obviously, if people aren't able to spend time on TikTok, naturally, that would be a big, Snap would be one of those big beneficiaries of that. It was a bit surprising to me that daily active users rose as much as it did, right?
Yeah.
A climb of 10%. And I think some of that, some of these results are kind of offsetting the fear that has been surrounding the stock for so long here when it comes to the growth narrative, what exactly that looks like here for Snap going forward. But we know under Spiegel, he's really worked to reshape the company over the last couple of years. And judging just from this print, that turnaround really starting to take effect here. You can see it, the fact that the company did downsize their headcount to a certain extent, has been cutting projects, slashing projects that weren't boosting their bottom line. So they've been reallocating some resources here over the last several quarters. Also, Brad, we were just talking about reworking their advertising business. So a number of those initiatives are really starting to pay off here for Snap, and we're seeing that stock pop. It's always a wild mover here after earnings. This time, though, it looks like investors are extremely pleased by these results, and we're looking at big gains here ahead of the open. All right, let's quickly take a look at Roku because shares are falling after the company warned that the financial benefits from price hikes are starting to fade, citing, quote, a higher mix shift towards ad-supported offerings. Now, the streaming company did, however, forecast higher than expected sales here for the current quarter. You're still, though, looking at losses of just about 3%. I think a lot of that has to do with increased competition. I was looking at the immediate reaction here from some of the analysts. Seaport was one of the analysts out saying that the rivals, increased competition there from more ad tier streamers could pose a risk to Roku here, at least the investment narrative in the short term.
You know, it's kind of bringing me back to some vibes or some conversation that we were having yesterday with regard to Comcast and what they were talking about within their streaming business as well. Given the competitive landscape that you mentioned a moment ago, heavy advertising, marketing expenses that you also got to think about in order to make sure you're bringing on more customers that stick around. So customer acquisition costs go up, the margins get squeezed. Total gross margin here was down by about 1.5 basis points, or 1.5 points is what they say, but percentage points here. All right, there you're taking a look at the opening bell here on Wall Street, and then additionally in Midtown Manhattan at the Nasdaq. Taking a look at these bell ringers here. Well, I can't see the names of them anymore because they've gone away. Hey, there's the nicey one. The NYSC is what they like to be called. Ticker symbol AROC. Oh, right. All right. Anyway, let's do a quick check of the market, sponsored by Tasty Trade here this morning. The Dow, the S&P 500, and the Nasdaq there on your screen. We are mixed as of right now. Let's take a look at that Dow, flat, barely to the upside by a hair on its chinny chin chin. S&P 500, you're seeing that up by about 0.7%. And there we go. We got the Nasdaq calibrating, and it's higher by about 1.4% here out the gate this morning.
Yeah, certainly. The major markets here, broader markets, really getting a boost from some of those earnings results that we got after the bell last night. When you look at the gains in Microsoft, especially the gains in Google, a huge move to the upside here at the open. That's helping to boost some of the movement that we're seeing to the upside there. It's also important to take a look at yields because we have yields falling back just a bit off of those elevated levels on the heels of that PCE print. You've got the 10-year off just about 3 basis points, I believe, here in early action. All right, let's get to more coverage here. Some of the movers that we are closely watching on the street. Yahoo Finance's Jared Blicker standing by with a closer look at some of the movement in commodities. Jared.
Thank you. Yes, I'll get to commodities in a second. I just want to show the S&P 500. We are approaching a key technical level. So this blue line, this is, by the way, the S&P 500 back to the beginning of the year. Blue line is a 50-day moving average. We also have a 20-day moving average, which is about to cross over. Bottom line is where the rubber meets the road is 51.20 to 51.30. That's somewhere up here, and we are not there yet quite yet. But if we do rally, I want to watch that level, that area very closely. Also taking a look at bond yields, you were just saying the 10-year climbing to the highest in quite a while. Well, we had slightly higher prices yesterday, but for the most part, we're looking at the highest prices of the year. That can weigh on stocks as well. And then just looking inside some of the sector action, here's what's happening today. Communication services, that is a home of Alphabet. It's a home of Meta. It is #1 today. Tech also doing well. Those are the only two outperformers. Energy, the worst sector to the downside. And just wanted to spend a second on XLC. That's the communication services sector. Here's a 5-year chart. This took a deep hit, and that was largely on Meta weakness, but also Alphabet weakness. And now it is right back up to where we started in 2021. Those were record highs. So we want to watch the price action carefully around this. You can see there might be a little handle there for this cup, but we'll have to see. I did mention commodities, so I want to hit that real quickly. I'm going to show you a 1-month trailing chart here. I think this is an important part to make. A lot more winners than losers. Coffee is up 18.5%. That's #1, but we also have aluminum, copper, wheat, cocoa, silver, hogs, gold. All these things are surging higher. So this is really a month where stocks have kind of fell by the wayside and commodities have really taken over, guys.
All right, Jared, thanks so much for giving us a closer look at some of those movers here at the open. Well, coming up, keep right here on Yahoo Finance. We got much more at stocks holding on to gains despite that slightly hotter than expected inflation print. We'll tell you why when we come back. Market shrugging off a slightly hotter than expected PCE inflation reading today. The biggest catalyst for the markets this week, well, it's been the inflation print and the GDP print that we got yesterday, but also big tech earnings. That has really pushed some of those major averages higher here. So let's talk about where things stand today. For that, we want to bring in Youngyu Ma, BMO Wealth Management U.S. Chief Investment Officer. Youngyu, it's great to have you here. So talk to us just first, before we get into earnings, more specifically how you're looking at this PCE print that we got this morning and what exactly you see the signaling here for equities when we factor in the potential Fed decision here down the line.
Thanks, Shauna. Great to be here. We consider the PCE print essentially in line, and probably even the market was braced for something worse given some of the pricing data that was in yesterday's GDP report. So given the inline PCE report and those strong earnings out of some of the big tech names, Microsoft and Google, Alphabet, we think that that's really supportive of the markets here and helps to stabilize some of the negative sentiment that had been building in recent weeks.
Can strong earnings, if we continue to see that, especially knowing that we're going to have some more Mag 7 names reporting next week, can strong earnings offset or allow investors the opportunity to kind of diminish the role of the Fed or fade the Fed risk or headwind and just lean into what the CEOs are saying right now about the macroeconomic environment?
We definitely think earnings are important here and the growth trajectory is important. But it's also worth noting that since the market is more relying on growth now for both stabilization and any upside gains, I think we have more of an inherent push and pull to the market because that growth is somewhat uncertain. We do think it's going to materialize and actually accelerate in the second half. But once you pull away the backing of the Fed and having the Fed more on pause now, interest or inflation being a little bit stickier and a slow path down, we do think that that does mean a little bit more of a choppy market, but we think that growth as it accelerates in the second half or is set to accelerate in the second half will still underpin a healthy market and provide for a good environment here.
Youngyu, what do you think this really tells us about the action that we could see in the bond market when you have core inflation continuing here to, at least for now, trend higher? Does that leave 5% yields then in play?
5% 10-year yields we think are definitely in play. We think that we both have stickier inflation. We think over the long term it will come down, but that path is probably somewhat slow. But you also have growth, which we think is going to hang in there this year and actually accelerate in the second half. And you combine that with high deficits and funding needs by the federal government. And we think the 10-year yields are probably going to drift upward for the remainder of the year here. And that's part of the inherent push and pull that we see happening in the markets, that you can't get too enthusiastic about growth if some of that growth starts pushing up those yields a bit higher.
Does that push and pull mean that a soft landing has already happened, Youngyu?
We think so. We think a soft landing is in the rearview mirror, despite Q1 GDP, the headline number at least, coming in soft. We think some of the components looked healthy and actually business spending looked healthy. And we think that the second half of the year is really going to be driven by both a stable consumer, but then business spending accelerating. So we're actually putting a stamp on the soft landing and think that right now the thing to look forward to is where the growth is going to come from and how strong these AI and productivity themes are going to be for the rest of the year.
And so if we did see that, a resilient consumer plus business spending accelerating, how does that not create an environment where inflation rears its head once again?
Yeah, that's a great question. We do think the path for inflation coming down is going to be slow. But if you think of what some of the drivers are, wage growth isn't accelerating anymore. We think that's moderating slightly. And also some of the stickier components, such as shelter, are likely to come down over the next few quarters. So we think there's some elements in place for moderation of inflation, but we also have some sticky elements, such as within the inflation components, insurance has been very sticky. Healthcare looks like it's going to be sticky as well. So it's going to be a long road, but we think that ultimately part of that growth that we get is going to be growth in productivity, and that helps to soften the inflation blow a bit.
Some of the future productivity, improvements that we could see driven by AI here. And Youngyu Ma, I want to get your thoughts just on the AI investment story, because it seems like investors were a bit skeptical of where we were in the cycle, or at least the investment opportunity here ahead of earnings. But when you take a look at Google's results last night, you take a look at what we heard from Microsoft, does that then leave the AI investment story? Is that intact at this point? Is there still an opportunity there?
I think the AI investment story is intact. The enthusiasm for AI is going to come in waves this year. I think that's worth noting. The data is not going to be a consistent, steady flow. But I think if you look at the medium-term trajectory and even longer-term trajectory, the spending that's going to take place, not just by these mega cap tech companies, but across the board by companies that are looking for ways to improve productivity, looking for ways to implement AI to improve their business. I think this has a very long runway. So despite the waves that might come for the enthusiasm, and that sometimes those waves can include a bit of an ebb and a slowdown, but overall, we think directionally, that enthusiasm, the strength of that spending is going to be supportive of markets here this year.
Young Ma, BMO Wealth Management U.S. Chief Investment Officer. Thanks so much for the time this morning. Really appreciate it.
Thanks, Brad.
Thanks. Coming up, Exxon and Chevron both out with their earnings this morning. We'll break it all down for you next.
Exxon and Chevron sliding this morning after first quarter results missed expectations here for the companies. Now the impact of weak natural gas prices weighing on those results. To help break it all down, we want to bring in Neil Dingman, Truist and Managing Director of Energy Research. And Neil, it's important to distinguish some of the differences here that we're seeing within these reports. I want to start off with Chevron because when you take a look at the share reaction there, investors don't seem to be too impressed. Profit actually did top expectations, but sales missed. So I'm curious just your reaction to what we're seeing play out in the market here this morning and what this signals here for Chevron, at least in the short term.
Thanks for having me. I would say it's not a total surprise. I mean, again, when you look at year-over-year prices, both or I'd say all three. You would look at gas prices, oil prices, even refining margins. We knew that they were going to be down, maybe a little bit weaker even though than we were expecting. So I think near term, we're still a little bit, a little bit of pressure on that. But I think, look, if natural gas prices rally as the strip indicates they should or could next year, and oil prices remain firm, I think both Exxon and Chevron are set up quite nicely.
It's interesting for Exxon. They were talking about what seems like some of their cost management strategy as well, and exiting from certain business and then the existing businesses that they do have where they're making further investments. Where does that, and this seems to be a theme of the day, is the capital expenditures that companies are putting into the vision for this next year, especially given some of the targets that Exxon has put forward by 2027 and the cumulative savings here. But how much do they have to spend in this near term, and the investor calculation around that as well?
Yeah, it's a good question. That you're right. Now that all these companies are looking at this flat production profile, Chevron and Exxon are not unique. But what's unique about Exxon, they talked about already achieving $10 billion in savings on the way to their goal of $15 billion of savings through 2027. I certainly think they're going to continue to hit that. So what you're going to see is just kind of flat on a flat spend. Look, at the end of the day, I think, Brad, the key for these companies continues to be free cash flow and what they're able to pay out or return to investors. Both of these companies returned over $6 billion this quarter. Again, you look at Exxon, they paid out about 101% of their free cash flow. Chevron paid out over 120% of their free cash flow. Again, the key remains, I think, the shareholder return for both of these.
Yeah, Neil, when you take a look at these production numbers, at least for Chevron, they were talking about strong execution in the Permian Basin, just to name one of those regions here that did obviously, I guess, please investors to a certain extent. When you take a look at what those numbers you were expecting to look like in the current quarter that we're seeing now in the second half of the year, is that going to be continuation, do you think, of what we saw in the first quarter?
That's right. Sean, it's just be a very, very slight growth. Again, they're going to have big growth, as you pointed out, in Guyana and in the Permian, over 10% in the Permian, but that's just going to help keep the remaining or their overall portfolio flat. Guyana is the one worth pointing out. I mean, if you look at the projects coming on through 2027 on a gross basis, which again, Exxon has 45% of this, that could do almost 1.2 million barrels a day. You think about that. The U.S. alone is doing about 13 million barrels. So this is encroaching on over 10% of what the U.S. alone, this project could be doing by 2027. Obviously, that's why it's a big deal on this litigation between Chevron and Exxon on the Hess deal. I can't say enough about this Guyana project. When you look what's coming on quarter after quarter, year after year, it's a mega project, to say the least.
How do some of the new projects that either of these companies are talking about get them closer to some of the targets that they, as well as some of their partner companies, have talked about with regard to cleaner energy solutions in the future?
Yeah, I asked them that today. It's interesting. They still have direct air capture, advanced recycling. There's a lot of things they do on that. But again, it's still a pretty small amount of total capital spend. Simple reason being is the returns are not near as they are in the upstream or even the downstream segments for that matter. So again, I think they are going in that direction. Do I think in the next 2 or 3 years it'll be even close to 20 or 25%? Absolutely not. But they continue to look at different types of projects on that scale. But they're also considering, when they're looking at these projects, they have to gain a return that is commensurate maybe with some of their traditional type projects.
Neil Dingman, who is the Managing Director of Energy Research over at Truist. Neil, great to see you. Thanks so much for taking the time.
Thanks, Brad.
Coming up, vibes are good on Wall Street, at least for Microsoft and Alphabet. We've got the bullish takes on the other side. Good vibes on Wall Street on the back of Alphabet and Microsoft's earnings reports. Both companies getting higher price targets from multiple analysts this morning. The commentary overall was positive, with most of the street enthused about the AI opportunities for both of the tech giants. And Meta probably somewhere saying, what gives? But at the end of the day, you've got a lot of reviews here positive on these earnings results. We'll start with Alphabet here. And one that stuck out to me, good friend of the show, Brent Thill, at Jefferies analyst, maintaining the buy rating, upped his price target by $20 to $200, saying the shares are trading at an attractive valuation, and the acceleration in core ad and cloud revenues were a bright spot. But here's what's interesting. The CapEx actually did come up for him and remains a little bit wary of that. So we'll see exactly, as the company had talked about that jumping potentially 50% this year, fueled by some of the AI investments.
Yeah, that stuck out to me because I think the overall sentiment, at least the majority, are kind of brushing off the massive increase that we've seen in CapEx spending, really across many of these names, specifically what we're seeing, because we're talking about it today, with Alphabet from Google. We heard from Rishi Jaluria earlier in the show, basically saying that the street is almost on board with that type of spending, given the results that it is expected to see and has seen up until this point. And you talk about that growth opportunity then going forward. And that was echoed in some of the notes that we were getting out today. Bank of America saying that Alphabet is still well positioned for the long term. They have an outperform rating on the stock right now, although they did keep their buy rating on the stock. They kept their price target of $200 a share. But I think overall, you can see it clearly reflected in the share price here today. The street, when it comes to investors, when it comes to analysts, extremely pleased from the results that we got out from Alphabet. And I think a lot of people were almost bracing themselves ahead of the results that we got from the two tech giants last night, wondering whether or not Meta was almost a reality check for other big names within this sector. But you can clearly see the differences here with their business models and exactly some of that input cost and what that ultimately means for their bottom lines here, at least in the short term. And then flipping over to Microsoft, a similar sort of story there. We're seeing that those shares move to the upside again. We did see an increase in CapEx when it comes to AI spending, but the street okay with that. And you can see it clearly paying off when you take a look at the Azure numbers. Clearly, we're seeing some revived growth there, something that the street had been looking for now within this quarter. So the expectation for that to continue and the expectation for AI to contribute even more to that growth story down the line has many names, two on your screen right now, Wells Fargo and JP Morgan among the analysts raising their price targets on the stock today.
Morgan Stanley also within that group here, and the analyst Keith Weiss also saying in addition here that he sees the clearest evidence yet of the tech company's AI dominance here in Microsoft, and also with the AI innovation cycle just starting, he sees plenty of runway for growth here for MSFT. I mean, this is seeming like a five-tool baseball player, Microsoft right now.
It certainly does. All right, well, keep right here. We got a lot more on that. We're also going to be taking a deeper dive into what is keeping inflation so sticky. Plus, our very own Brian Sazi will be sitting down with Newell Brands CEO Chris Peterson.
And in the 11 a.m. hour for Wealth, we break down the tech rally and what it means for your portfolio. Plus, Saz and another CEO. This time, Intel CEO Pat Gelsinger at 11:20 a.m. Eastern Time. Don't go anywhere. You don't want to miss it.
Welcome back to Yahoo Finance. I'm Shauna Smith alongside Brad Smith. We are 30 minutes into the trading day. So let's get to our big stories here that we are watching. Stocks holding on to gains to end the week with inflation showing little signs of easing. PCE, core PCE, increasing 2.8% from a year ago for the month of March. That was hotter than what the street was expecting. Stocks, though, still moving to the upside. A lot of that had already been priced in. We also got the strong results out from Alphabet and from Microsoft after the bell yesterday.
And the bills are coming for those tech companies. The latest results from Alphabet and Microsoft showing both big tech companies had record capital expenditures in their March quarters, but unlike Meta, both companies had strong earnings driven by growth in their cloud sectors. Very interesting here.
And also the energy sector under some pressure this morning. ExxonMobil and Chevron falling as both companies report profit declines in the first quarter. Now, both the companies are also getting hit by declining nat gas prices and refining margins. And you can see losses there. Chevron moving off by just about 0.5%. Exxon off nearly 3%. We also want to get to some breaking news that we got out here this morning, top of the hour, on consumer sentiment. We've got that data coming in slightly lighter than expected here. A final reading of 77.9. The index had been at 79.4 the prior month here. And digging into some of these expectations here, expected change in median prices during the next year, that rose to 3.2% versus 2.9% here the prior month. Also, current economic conditions, that index falling to 79 versus 82.5 the prior month. So a bit of a cooling, it looks like, on this final reading of the consumer sentiment index here for the month of April.
Yeah, taking a look at the market reaction as of right now, you're still seeing gains across the board here. A lot of weight given to the PCE number earlier this morning, as we did see some waffling. However, out of the gate, we were higher, except for the Dow, which was trying to make up its mind. But as of right now, we've moved higher even from those levels that we started off the day, with the Nasdaq leading the pack on a percentage gain basis. You're seeing that up by about 1.7%. The Dow has firmly entered into positive territory. That's up by about 0.5%, and the S&P 500 seeing gains as well of about 1%.
The latest core PCE reading showing that prices increased more than Wall Street expected in March. The recent inflation reports we've been seeing are dampening investor expectations for the Fed's interest rate cuts. Hot readings could reignite the central bank's rate hike, according to our next guest potentially here. So let's bring in Lindsay Pieggs, the Stifel Financial chief economist. Lindsay, it's great to see you. So just your reaction to the print that we're getting here this morning. Yes, it shows that inflation does remain maybe a bit hotter than what the Fed anticipates or would like to see at this point, but not really ringing too many alarm bells yet. Is that right?
Well, you're right. It wasn't necessarily a material increase, but this is significant for the Fed, who was expecting a sizable reversal in this disinflationary trend, which as of the start of the year now has not only arrested, but we've started to see mounting price pressures move in the opposite direction away from the Fed's 2% target. So for a Fed desperate to provide relief, this is far from the ideal conditions when we talk about rising producer, consumer, or the PCE, as we saw this morning. So this is going to complicate their outlook and potentially delay any conversation about near-term rate cuts. And I think it's going to, at the very least, put the possibility of re-engagement and further rate hikes back on the table.
You know, it's really interesting, Lindsay, especially when we pair together all of the economic data readings that we've got this morning. And we were just mentioning consumer sentiment. It seems right now consumers continuing to express uncertainty about the future trajectory of the economy pending the outcomes of things like the election. You've got exogenous threats that, of course, we never know until they happen. All of these things considered, is there any dampening of the demand environment that we're hearing about from companies right now that we see deteriorating further, or does the resiliency look like it's going to remain intact?
Well, right now, the consumer does appear to be very resilient, continuing to spend on particularly services in this environment. As we saw with this morning's number, the consumer is still spending at an annual pace up near 6%. But when we parse through some of the details, as we saw in the GDP report, consumers are being more choosy on where those dollars are being allocated. So not all businesses, not all sectors of the economy are faring equally in this environment. So that being said, broad-based growth has slowed as as momentum has slowed. Consumers are still spending, but they're doing so at a noticeably slower pace. And so as a result, growth, top line GDP has come down from 5% to 3% at the end of the year, let's call it, to now below 2% as of the start of the year. So there are signs of fatigue, but the consumer, as the backbone of the U.S. economy, does still appear to be the strongest support to growth going forward.
And Lindsay, so that sounds like something you expect to continue here, at least for the coming quarters, if I'm understanding that correctly. So what does that then tell us just about the ultimate timing here for a rate cut, how unlikely or likely it could be here before the end of the year?
Well, I think it comes down to the performance of inflation. If inflation stabilizes at the current levels or even ticks up maybe slightly higher, I think by the end of the year, given that the Fed is desperate to provide relief, I think the committee may still be willing to give us 1 or 2 rate cuts. But without more of a meaningful decline or improvement in inflation, after that minimal concession, I think the Fed's hands are tied, and we'd likely see the Fed move back to the sidelines for a second-round extended pause. And in fact, even if inflation does revert back to a disinflationary trend, I think rate cuts from there would be very slow, very tempered, very controlled, leaving us well beyond neutral, not just beyond 2024, but well beyond 2025 as well. But the biggest risk is if inflation doesn't behave as the Fed anticipates. The biggest risk is if inflation begins to more meaningfully reverse course, not only in terms of the month-to-month increases, but on a persistent basis. At that point, I think the Fed's hands may be tied to, as I mentioned, re-engage and put the possibility of a further rate hike back on the table.
Lindsay, getting kind of a roundup of thoughts on this, has the Fed successfully initiated a soft landing yet, or is that still up for debate or up for seeing in the data coming forward?
I don't know if we've necessarily seen a soft landing, as we're still working through the cycle and price stability has yet to be achieved, but we're certainly at a soft pause or a soft phase of the cycle at this point. And the Fed certainly wants to perpetuate these solid conditions in the environment out in the economy. Again, and that's the motivation for why they want to initiate these rate cuts as soon as possible, as soon as the inflation data allows. But right now, with inflation reversing course since the start of the year, the Fed is on an unfamiliar pathway, certainly on an unexpected pathway for when those that potential change in policy may come to fruition.
So, Lindsay, what does that then tell us about the expectations here, whether or not, or your confidence that we will achieve a soft landing? And if not, then what is the more realistic outlook, do you think, at this point?
Well, remember, to achieve a soft landing, the Fed has to raise rates to a sufficiently restrictive level in order to eventually reinstate price stability. But the goal was never to go from 8 to 6 to 3%, but to continue along that downward trajectory back to 2% on a sustained basis. It's not about touching 2%, but getting back to 2% and staying there for a prolonged period of time. And right now, I don't see any evidence in the inflation data that we are on a trajectory back to that level. So the Fed may be forced to re-engage in order to reach a sufficiently restrictive level in order to reinstate price stability. So the possibility of a soft landing is still out there, but I think the Fed still has a lot more work to do to ensure that we reach that mandate.
All right, Lindsay Peiggs, the chief economist for Stifel Financial. Thanks so much for joining us here this morning.
Thank you for having me.
Well, coming up, we have seen a number of companies beat earnings expectations this quarter, but do those beats really matter? What is Wall Street looking for inside the reports? We will discuss on the other side. So a quick check of the market sponsored by Tasty Trade. 43 minutes into the trading day, and you're looking at gains here for the S&P and for the Dow, the Nasdaq, all three of the major averages trading to the upside. You've got the S&P now just above 5,100 as we flip back to that. You also got the Dow in the green today as well. Now the move higher coming despite that slightly higher than expected core PCE inflation print that we got out this morning. You can see the Dow now up just around 200 points. You've also got the Nasdaq trading to the upside here, up just about 2%. A lot of that strength being driven by those larger cap tech names in today's trading action. You can see that clearly on display from the sector action that we are seeing here this morning. You got communication services, also technology, the outperformers of today, utilities and energy lagging. We got those disappointing results from Exxon and from Chevron. That's weighing down the energy sector here. But let's take a closer look at the leadership that we're seeing play out in the market. You don't have to look any further than these two names on your screen. You've got Google up just around 9.5% today in early trading. You've also got Microsoft adding to those gains, up about 2.5%. So both of those results, we've been talking to strategists, we've been talking to a couple analysts here this morning, and the takeaway, at least for me so far up until right now, has been the fact that these two results here from Google and from Microsoft really put that AI narrative back in play, enough to excite the market, and we're seeing that reflected in the broader market gains so far this morning. All right, well, it has been a roller coaster week for markets as big tech earnings passed a crucial test. We've seen stocks reacting more than usual to earnings announcements this time around. Markets are poised to end the week higher thanks to AI-fueled rallies from Microsoft and from Alphabet. So where do we go from here? We want to bring in Nicole Inouye, HSBC's head of equity strategy for the Americas. Nicole, it's great to see you here. So talk to me just about your reaction to the earnings prints that we've gotten up until this point and whether or not it's enough for the market to continue here to move to the upside.
Yeah, great. Thank you for having me on. You know, earnings have come in actually much stronger than expected. So looking at the percentage of earnings beats, about 75% of companies that have reported so far have beat earnings, but the price reaction hasn't been so great. So if a company misses, yes, you're seeing those companies punished, but companies that are beating, you're not seeing necessarily that increase in the share price that you would typically see. And we think this is because investors are scrutinizing even more earnings and forward guidance. So if you look into the second half of the year, you actually see earnings expectations are pretty high. So when we see companies reporting earnings, it's not so much what they're reporting in the quarter, but what they're saying for the second half of the year. And I think the market really is expecting that that guidance is actually better than what they've already priced in right now. So that's the reason why the reaction hasn't been as strong for many of these names as we've seen in the past.
So then, Nicole, what does that signal then for the current quarter that we're in right now and also the second half of the year? If we have these low expectations like you are setting, or that like you are saying, it's setting the stage for some beats, is that going to be enough then going forward?
No, I think so. We're still very constructive U.S. equities. We have a price target of 4,500 for the S&P for the end of the year. I think first quarter near-term expectations are very low, so that does set a very low bar for an earnings beat. And we have to remember what we're seeing on the GDP growth side. And I think we keep forgetting that 6 months ago, the market was expecting that the U.S. would grow less than 1% in 2024. Now we're at 2.4%. So that is very supportive for earnings growth over the second half of the year. So yes, expectations are on the high side, but we think with this GDP growth that we expect to stay resilient, we think that companies can deliver on that earnings growth expectation over the next few quarters.
Nicole, one thing you haven't mentioned yet is the Fed and whether or not the Fed is going to cut, how that's factoring into your projections. Does it matter at this point whether or not we get 25, 50 basis point cut before the end of the year?
I don't think it matters when we get the cuts. I think it matters that that narrative still needs to be in place. So, the inflation data that we saw today is in line with what we were expecting. But what it's showing is that inflation is staying very sticky. What we don't want to see is a reacceleration in inflation. We think if we get that, then we start seeing this narrative shift from not when the Fed will cut, but if the Fed will hike. So as long as we're in this continued narrative that the Fed will eventually cut, It doesn't matter if it's June, July, September, December. As long as that narrative is in place, we think that is still very supportive for equity markets.
Nicole, you said if the Fed will hike. It doesn't sound like you think it's too likely at this point, but what is your expectation when it comes to that, and obviously the potential implications then for the broader market?
Well, I mean, we do have a bear case scenario of the S&P reaching 4,800 at the end of the year, and that is a no Fed cut scenario, and this narrative shift from, the Fed's not going to cut, but the Fed will hike. And if we see that, obviously that is a headwind for valuations. It's a headwind for earnings, as you see corporates will actually probably have cost pressures if that inflation moves a little bit higher. So that is really kind of the downside scenario that we have for the S&P, the no Fed cut, and actually the market's starting to price in a Fed hike. We still feel like we're pretty far away from that right now, looking at the data that we've seen recently.
Nicole, talk to us then about your strategy, where you're seeing opportunity, how you are positioned then heading into the second half of the year.
Great. So, we're still very positive big tech. We think it doesn't really matter if rates stay high for longer for tech. These companies, a lot of them have very strong balance sheets. They're net cash. So if we do see rates staying higher for longer, we don't see that having an impact on the balance sheet. And also, they're delivering on earnings. This is a secular growth story. So we think that sector continues to stay strong over the second half of the year. Another sector we like is consumer discretionary. And this really, we're taking kind of this barbell approach where we like companies that are focused on the high-end consumer. We think the high-end consumer will continue to do well, even if rates stay higher for longer. They have these fixed rate mortgages. They have the wealth effects from higher home prices and higher equity prices. So we think stocks focused on that sort of sector will do well. And as well, in the low income sector, you could see this trade down of the middle income consumer trading down, which could help some of those companies that are really focused on the lower end consumer as well.
All right, Nicole Inouye, great to get your insight. Thanks so much for hopping on with us this morning. HSBC's head of equity strategy for the Americas. Thanks so much.
Thank you.
Well, coming up, we are taking a look at the U.S. dollar after inflation coming in slightly hotter than expected. We'll get a guest take on where we are headed. Obviously, that move to the upside, whether or not that's going to continue. We'll be right back.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance. The U.S. dollar trading to the upside here this morning following another hotter than expected core PCE print out earlier today, showing that inflation once again remaining a bit sticky. Here to break it all down and what exactly this means for the FX market, we want to bring in Mark McCormick, TD Bank, a global head of FX and emerging market strategy here. It's great to have you here, Mark. So let's talk about that upside here. We've got another surprise in inflation. Is this going to kickstart another round of strength, do you think, for the dollar?
Yeah, I think this is actually very meaningful. The one thing that's kind of challenging about FX markets is it tends to change its focus very quickly. Correlations change, and it kind of changes what it wants to look at. So for a while, the market's been really focused on the relative growth developments between the U.S. and the rest of the world, where the rest of the world's actually been narrowing that gap. Last 3 months, it just completely flipped, and upside surprises in inflation, which have been generally ignored by the market for most part of the year, has become the most important dominating theme in FX. And what it's doing, it's changing the factors in the way that the market's working, because what we've seen is that global growth was being upgraded, financial conditions were easing, central banks were cutting, and that has actually seen the dollar not really track interest rate differential. So the dollar should have been stronger than it was for months. And now what we're seeing is that inflation is taking over, and it's very strong in the U.S. relative to other countries, particularly in the G10, not so much in emerging markets. But that is now what's dictating the market outcome, which is everyone's focused on, will the Fed cut? Can the Fed cut? But we know that the ECB is going to cut, the Bank of England is going to cut, the Bank of Canada is going to cut. So now we see clear divergence. So inflation is the number one thing that matters for the dollar right now.
And Mark, talk to us a little bit more just about that FX trade-off then, given the current environment right now, given the fact that we could see the Fed staying on the sidelines, we could see activity from other central banks. You just mentioned the ECB cutting here in June, and ultimately what that then tells us about the extent of the upside potentially here for the dollar.
Yeah, it's quite important because, too, there's also, the big elephant in the room is there's an election this year. Yeah. So there's dynamics in the FX market that work through geopolitics. One of the things that we see is that FX volatility is quite low relative to geopolitical uncertainty, the indicators that we track. So what we've been thinking is the dollar, as we kind of come through the summer, should be quite stronger anyway, because we do think the market and the election and all these things should be realized through much higher volatility. I think what's happening is now the Fed's window to actually cut rates, whether it be in September or July, is narrowing quite significantly, which also I think there's a lot of debate. We have these conversations with clients. Can the Fed actually cut in September, just given the proximity to the election in general? And if that becomes an issue because inflation's starting to reaccelerate, or it's sticky, or it's hot, then the market's kind of pricing no cuts. So I think the modalities here, or the expectations of where the dollar can go, is the dollar can get much stronger from these levels, given what we've seen transpire over the last couple of weeks and the last couple of months in terms of inflation, and how the market's now pricing real divergence between G10 central banks and the Fed.
Mark, talk to us a little bit more just about the risk of the U.S. dollar getting too strong, and then what could happen next as a result of that.
Yeah, that's another interesting, we always in finance and markets in general, you have to kind of think of first order effect, second order effect. It's very clear that there was a statement last week from Korea, Japan, and U.S. officials that they are worried about the Korean won, the Japanese yen, and they kind of got the green light to intervene. The BOJ did nothing overnight, which has kind of continued to see pressure on the yen. An interesting part here is the BOJ does not work directly, or they work directly, but the Ministry of Finance controls FX movement. So what you can see here is intervention on the yen. We've also seen how central banks have to change their mindset. Do they want to control the FX rate and allow the currency to not weaken, which is what we saw in Indonesia? Or do we want to let the currency kind of be dictated a little bit by the market and see further currency weakness? So the interesting thing that's happening is if we do get this wedge where the dollar continues to strengthen from now until the election, and even get stronger through the election, depending on who wins, the environment can lead to what, if you go really far with it, there's discussions about a new Plaza Accord that's kind of being reported, that's being discussed, that you could see if Donald Trump wins and Lighthizer is Treasury Secretary, they have had conversations, and there's public discussions around whether or not you'd want to devalue the dollar relative to other currencies that are quite cheap. We do see some intuitive logic in that if the Fed can't cut, given inflation and other central banks cut, and you get an excessive move in the dollar in the next 6 months, and then you have continuation in the dollar if Trump were to win, you can see how you can kind of get to an environment in mid 2025 where the dollar is just aggressively too strong and there is kind of a global push to weaken it.
Yeah, Mark, so the timing of it doesn't sound like that would potentially, if all that scenario is played out, that wouldn't be an early 2025 story. It would almost be a latter half 2025, maybe even early 2026 story. Is that right?
Yeah, that's the first and second order effect. First order effect is the macroeconomics, right? It depends clearly on if there's no Fed cuts, U.S. economy is generally reaccelerating. And if the environment is risk off and higher inflation, that does favor Donald Trump and it doesn't favor the incumbent. So in that environment, the markets kind of have to recalibrate to new macroeconomic potential policies, or at least price in the risks, which is tax cuts and tariffs, which are things that have been discussed quite frequently. So those are inflationary themselves. So the entire outlook if you think about further corporate tax cuts or extending those tax cuts next year, along with tariffs on other countries, that also would reaccelerate the strength of the dollar that would come through in the fall. So those are things that would be the first order effect. And in that environment, the dollar gets aggressively stronger in 2025, which then sets up the potential for policymakers around the world to say, the one thing that we do know is if the dollar is very strong, it's bad for global equities, it's bad for global growth. And that's an environment where if the dollar gets excessive based on those type of scenarios, that's where, the second order effect is some kind of policy move.
Mark McCormick, great to talk to you here this morning. Thanks so much for taking the time to join us. Mark McCormick, TD Bank Global Head of FX EM Strategy. Thanks so much.
Thanks for having me.
Coming up, shares of Under Armour under pressure, off over 20% in the past year. The retailer just going through a corporate shakeup with the ousting of its former CEO in exchange for the return of founder Kevin Plank. After the break, Yahoo Finance goes behind the scenes to capture the apparel giant's corporate turnaround story, what it will take for the struggling brand to bounce back. That's next.
Under Armour has long been known and often heralded as the underdog in the cutthroat sportswear apparel world. More recently, though, it has been dogged with controversy, lackluster sales, a few public missteps by founder Kevin Plank, and a bit of a revolving door at the C-suite that has left investors holding shares of a company valued at 85% below its record highs. In early March, the most recent CEO, Stephanie Linnartz, was let go after just 13 months on the job. She was the third CEO in 4 years for the company. Linnartz, a longtime Marriott executive, was brought in to overhaul a company struggling on multiple fronts, from digital marketing to corporate culture to shareholder value.
Breaking news, Kevin Plank returning to Under Armour as its CEO, replacing Stephanie Linnartz, who just rounded a year in her tenure as head of the company.
Corporate shakeups at the C-suite level are not uncommon, although according to sources Yahoo Finance has spoken with, this one came as a surprise to many, including Linnartz herself. News of Plank's return did not sit well with Wall Street, the stock falling more than 10% the morning after the announcement. Plank, who founded the company in 1996, had a successful run in the early 2000s, building the brand and inking lucrative sponsorships. But by 2019, Plank stepped down as CEO amid financial missteps and controversies. While down, Under Armour is not out. It is still a recognized brand globally with numerous partnerships, especially among colleges. But with Linnartz's departure and Plank's return, analysts and investors are waiting to hear how Under Armour plans to become a stronger competitor against the likes of Nike, Adidas, New Balance, and Puma, among many others.
Nice to see you.
When Yahoo Finance sat down with Linnartz at Under Armour's Baltimore headquarters in late November of 2023, she had already begun implementing a 3-year turnaround plan dubbed Protect This House 3. The plan was aimed at increasing U.S. sales, elevating design and product, with a focus on footwear and sports style, and driving global brand heat.
You'll see a new look and feel to our marketing. You'll see a new look and feel to where you can buy Under Armour. But, nothing happens overnight.
It's about 3 big things over the next several years to drive our revenue growth, our bottom line profitability, and it's really about building brand heat for the company.
She never got a chance to find that heat, and now analysts are looking at the stakes a little differently.
It's really critical that Under Armour put out high-quality footwear that has innovative features, is stylish, and really addresses the needs from the market and addresses what consumers want and what collectors want, and that's for all demographics and all age groups.
Under Armour has lost relevance among teens, according to a recent survey by investment bank Piper Sandler, which said, quote, "We continue to believe that Under Armour has lost relevancy with its target demographic." To do that turnaround, Linnartz focused on growing Under Armour's footwear business, especially in sports style and with women, where they do less than 25% of their business. It was a big ask for a first-time CEO in a new industry in such a short span of time.
The brand Under Armour has had stalled growth in the United States. That's factual. And so I knew one of the challenges that I'd have to address very early on in my tenure as CEO here was really figuring out how do we get that brand heat back in the United States? How do we grow sales?
She certainly wasn't given enough time. She had just made changes just very recently, had brought in new executives at Under Armour. There's been significant turnover at all major positions at the company. So she was not really given a chance to perform and to show that her reforms are going to work in the long term. She hadn't really made much of an impression with Wall Street at all.
Was it a big risk as a leader to completely change industries?
I think it was a risk, but I've always been a big believer that there's more upside to taking risks. I've always given young people that I've mentored over the years the advice to believe in yourself, to bet on yourself, to take smart, calculated risk. And I had done that throughout my career at Marriott International, but then I decided to do it in an even more significant way and switch jobs, switch industries, and lead the next chapter for Under Armour.
A chapter she will no longer get to see after Plank posted a statement to the company's LinkedIn page in mid-March announcing his return. Quote, "I want to thank Stephanie for her contributions to Under Armour. She helped advance the company forward in many important ways, including elevating our leadership talent in product, design, supply chain, consumer loyalty, and regional management." He also alluded to his time away from the CEO role, saying, quote, I have learned many lessons, professionally and personally. This period of self-reflection and learning has been invaluable, shaping my understanding of our business and reinforcing our mission, vision, and values. Plank was not immune to controversy, even before he left the CEO role the first time. Negative sentiment related to Under Armour products and to Plank's own statements were already impacting the company and its shareholders. In a 2016 interview, Plank praised President Donald Trump for being, quote, pro-business and a real asset for the country. His comments quickly came under fire from customers and his own star athlete endorsers, including Steph Curry and Dwayne "The Rock" Johnson. Plank later played cleanup, taking out a full-page ad in the Baltimore Sun, distancing himself from the Trump administration's immigration policies. In a critical 2018 Wall Street Journal article, Plank faced a hashtag #MeToo backlash for the company's alleged antics that included allowing employees to expense visits to strip clubs, which Plank put an end to after the article came out. Under Armour was also fined $9 million by the SEC in 2021 for misleading investors about its future revenue prospects.
CEO Kevin Plank announcing he is stepping down from the company he started more than 20 years ago.
Even after he stepped down as CEO, Kevin Plank was still very involved with Under Armour. He was still on the board and still the controlling shareholder and was still active in the strategy of the company.
Is it tough to change culture?
I think that it is, I do think it's tough to change culture, you know, that old expression that culture eats strategy for lunch, but I think you need to have a strategy for culture. I do think you need to have a strategy for culture, and I think that the CEO plays an important role in driving the culture of the company.
With news of Plank's return as CEO, there was a feeling of disbelief inside the halls of Under Armour, according to people close to the company who Yahoo Finance has spoken to.
I think a much bigger concern is that there's not much stability and clarity at the company at the moment. I mean, including Kevin Plank, this company has essentially had 4 different CEOs in the last 5 years. And you can't try to rebuild a company with such instability at the top. And the fact that Kevin Plank is coming back, although I think it was met with a lot of skepticism by investors, I don't think it was because they doubt his personal interest in the company. I think that they're well aware that he wants the company to succeed as much as anybody.
According to a study from Equilar, the median CEO tenure among S&P 500 companies has declined 20% from 6 years in 2013 to 4.8 years in 2022. Linart's lasted only 13 months. For her time, she will receive $2.6 million in cash, or twice her current salary base. The 2024 performance bonus invested stock worth about $7.3 million, as well as medical coverage for 2 years after data separation, according to an agreement that Linart's entered into 3 days before Under Armour announced that Plank was returning.
What I think Under Armour and Kevin Plank need to do is they need to prove to investors that there is a plan to expand the market and expand both geographically outside of North America, which still generates 2/3 of Under Armour sales, as well as to reach more demographic groups and increase its penetration in the core demographic groups that it caters to. And so I think that's what needs to happen before investors want to buy the stock.
That was our piece on the future of Under Armour with Kevin Plank back leading the charge. We also showed a bit of my conversation with former Under Armour CEO Stephanie Linartz. And Shauna, this is Linartz, I know her going back to when she was at Marriott, really changing the game there, especially as pertains to their rewards program. She got a bad deal here. Only 13 months in the job, and in a position like this, that is like Under Armour, where they have let customers down so badly over the past decade on product, customer service, you name it. She needed at least 2 years to start to turn this ship around.
Yeah, that certainly, it sounds like that had been the criticism really from many on the street. When you assume a new role, especially if you're CEO coming in as an executive to a new company, you need at least 6 months, 12 months, 18 months really to give yourself some time to familiarize yourself with every single division, and then you start to make those drastic changes. And like you were saying, 13 months, clearly no match, or really an opportunity for her to really turn anything around there at Under Armour. I'm curious what you make just of the strategists that you've talked with, the analysts that you've spoken with here over the last several weeks here since this announcement. What do they make as Kevin coming back as CEO? Are they at all confident that it's going to be different this time around?
The folks that I've talked to are concerned. I think they were taken back by Stephanie being shoved out the way she has. Now, keep in mind, Stephanie rebuilt the executive leadership team, rebuilt a lot of the ranks lower down from the executive level. These are people that she signed off on and had the high quality or a high quality resume and were just good human beings that she brought into the team. I do think a lot of folks are about to leave Under Armour at some point this year because they do not want to work for Kevin Plank, given all of his controversies and how he has historically led the company. So I would be watching that if you're an investor. Is there another executive exodus from the company over the next 6 months? I do think that is actually going to happen. But let's not make any mistake here why Kevin Plank is back. He's here to save his legacy. And that legacy is likely to be, he has to figure out, he's the controlling voting shareholder in the company. And as part of saving that legacy, he's going to have to decide what he wants to do with this company. Is Under Armour at this point in its lifespan, should it be owned by private equity out of public markets? It would be a way for him to maximize shareholder value, but also potentially bring the company back to relevance.
We will see what happens here under his tenure here the second time around. All right, Sas, thanks so much. Well, coming up, Newell Brands is seeing net sales fall over 8% from a year ago, but the company remaining confident in its full-year outlook. Shares trading to the upside today. We will speak with the CEO, Chris Peterson, next.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance. Newell Brands climbing higher today after reporting significant expansion in its first quarter gross and operating margins from a year ago. But the company did see net sales fall over 8%, citing the impact from unfavorable foreign exchange and business exits. Chris Peterson, Newell Brands' CEO, joining us now alongside Yahoo Finance's executive editor, Brian Asazi. Chris, it's great to have you here on Yahoo Finance. Thanks so much for taking the time to speak with us this morning.
Happy to do it. Great to be with you.
So let's talk about some of the improvement that you saw last quarter. You boosted your margins and narrower than expected loss here. What does that tell us just about where you are in your restructuring efforts and exactly how those restructuring efforts are paying off for your business?
Yeah, so we put a new strategy in place last June that was really focused on improving the rate of core sales growth, focused on improving our commercial capabilities of consumer understanding, brand building, innovation, and go-to-market. At the same time, we took that strategy, changed our operating model, and are very focused on driving margin improvement and cash flow. And that strategy that we've been executing against for 3 quarters, I think is starting to show strong results. In the first quarter of this year, which we reported this morning, our normalized EBITDA was up over 30% from the first quarter of last year, driven by a 410 basis point improvement in gross margin. Our core sales growth was down 4.7%, which we're not satisfied with, but was a significant improvement in run rate versus what we saw last year and in the back half of last year.
Chris, it's Brian here. Good to welcome to you to Yahoo Finance. How competitive is this category? I go down the aisles. Let's say I go to Dick's Sporting Goods. I see the likes of Yeti competing with things maybe that you sell. I see Stanley selling these mugs to everybody, seemingly everywhere. You sell, similar type products. How hard is it to get that game-changing breakthrough product into the hands of the consumers right now?
Yeah, it's a great point, and it's exactly what our new strategy is designed to do. We think we are the scale player in general merchandise. We're larger than most of our competitors that we compete against in each of the categories because they tend to be more single category focused. And in the past, we've been operating as a series of business units. One of the choices that we made as part of the new strategy is to create horizontal capability in the company around consumer understanding, put in place a brand building framework, and an innovation process that is consistent across the company. And when we do that well, we see we can grow market share and outcompete the competition. One of the initiatives that we launched in the first quarter of this year that we're very excited about is we just launched the Sharpie Creative Markers, which is a paint-like marker that goes on multiple surfaces, and the Papermate InkJoy Bright gel pens. Those 2 items, which we started shipping in February, already in March, are the top-selling SKUs in the writing category, and they're proprietary products that really outperform the competition. That's a good example of what we're trying to bring across the breadth of brands in which we compete.
I hear you, Chris, that you're investing a good sum of money in innovation, Sharpie, you name it. How, and in light of that reorganization that you announced a couple months ago, how committed are you to businesses like a Yankee Candle that perhaps might not fit into this new growth profile of Newell, and maybe you put that on the sales block and you could pay down some debt?
Yeah, so what we've done is we've made a series of where to play choices and a series of how to win choices as part of the new strategy. And on the where to play choices, when we did the strategy work about a year ago, we were selling about 80 brands as a company, but 25 of those 80 brands represented 90% of our sales and profit. And so we made the strategic choice to focus on the top 25 brands. Over the course of the last 9 months, we've already reduced the company's brand portfolio from 80 brands down to about 60. So the quality of the portfolio is improving. Similarly, we made choices on geographies. We play in about 42 countries around the world, but the top 10 countries represent about 90% of our sales and profit. So that's where we're focused. I think we've got a lot of opportunity organically. I don't believe that large-scale M&A is needed to drive shareholder value for the company in the next few years.
Chris, it's still a very massive portfolio of brands that you still have under Newell. I'm curious where you are seeing the most strength. Where are consumers spending the most up until this point?
Yeah, our categories tend to be a little bit more discretionary. So embedded in our guidance, we've said that we expect the markets in which we compete to be down low single digits this year in terms of consumption, as consumers are still under pressure from inflation on food cost, housing cost, energy cost, which has outstripped wage growth over the last few years. That being said, we think with the capability improvements that we're putting in terms of our front-end capability, we've set a goal of getting back to market share growth on our brands so that we improve the rate of core sales growth. At the same time, we think we've got a big opportunity to improve margins and drive cash flow. And we think if we do that, we can drive significant shareholder value and position the company well for when the categories begin to inflect positive again.
We've been having a lot of debate here at Yahoo Finance, Chris, about the inflationary outlook, but I imagine inflation is still very much with your business?
Yeah, we expect this year we're seeing input cost inflation low single digits. And really, the two main drivers of inflation for us this year are labor and overhead cost, first and foremost. And then secondly, we are seeing a slight increase in resin prices. But the environment of input cost inflation has reduced, but is still with us. We are not in a deflationary situation. The good news for us is that we have a very strong productivity program, and we're driving productivity savings that are above that level of inflation, which is helping us drive gross margin improvement.
Chris, we only have about 30 seconds here, but have you raised prices? Do you plan to raise prices then, given the fact that inflation is still a headwind here for your business?
We do not plan to raise prices in the U.S. This year. We have not raised prices in the U.S. this year. In some of the international markets where we're seeing dollar strength and currency devaluation, we are taking pricing. But in the U.S., we intended to maintain prices relatively stable to where we are today.
Chris Peterson, it's great to have you here on Yahoo Finance. Thanks so much for taking the time to join us, CEO of Newell Brands. And of course, our thanks to Brian Sozzi as well.
Thank you both.
Let's do a quick check of the markets here. 90 minutes into the trading day. We're still looking at gains across the board. You've got the Dow up just around 128. You got the S&P up just over 1%. The Nasdaq, the outperformer. Why? A lot of that has to do with the strong results that we got after the bell last night. Microsoft and Alphabet both beating the street's expectations, both soaring in today's trading action. And as a result, you're seeing a lot of those tech names here trading to the upside. Coming up next is Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour. He's going to be doing a deeper dive into what the results from Alphabet and Microsoft mean for your portfolio. Stay tuned.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's newest guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and those tricks that you need to grow your money. On today's show, rising mortgage rates. We explore if it's cheaper to buy or rent a house. And the best credit cards for your next home improvement project. Our reporter lays the details bare. Plus, meme stocks. We talk to an expert about whether stocks that gap up meteorically high and later come back down to earth, think GameStop and AMC, they make for sound investments. We're going to discuss all that much and more. But first, we take a look at some of the market action. 90 minutes into the trading day here, we've got the Dow, the S&P 500, and the Nasdaq loaded up on your screen for you to see. And let's run through it real quick. All three major averages are in the green. The Dow right now is up by about 0.3%. S&P 500 up by about 1.1%. And the Nasdaq Composite, tech heavy, is boosted by some of those earnings results. That's up by about 2.2%. Investors not appearing to be fazed by a hotter than expected PCE report for March. On an annual basis, core PCE came in at 2.8%. That's 0.1% hotter than expected. And the Nasdaq getting a big boost today from tech earnings. Alphabet, Microsoft, Snap, all out with results, all top trending tickers on the Yahoo Finance platform. Alphabet surging on an earnings beat in its first ever cash dividend and stock repurchase program. Executives stressing during the earnings call that Alphabet is well positioned to lead the shift to an AI-centric tech world. We also have shares of Microsoft, MSFT, they're rising on a top and bottom line beat, buoyed by strength in its cloud business. The company's CFO, Amy Hood, revealing on their earnings call that near-term AI demand is outpacing capacity. And we're also seeing some pressure this morning in the energy space. Shares of ExxonMobil and Chevron falling after revenue for both came in lower than the year before. Well, let's get back to Google's parent company, Alphabet, announcing its first ever dividend and issuing a stock buyback this week, sending the stock rallying. To break down what this means for investors, we've got Yahoo Finance's very own Julie Hyman. Hey, Julie.
Hey, Brad. It's great to see you. Great to be here. So let's talk about what this dividend and buyback are. First of all, as you said, it's the first time that Alphabet has ever issued a quarterly dividend. It's going to be 20 cents. It's payable on June 17th to shareholders as of June 10th. So what does that mean? You have from now until June 10th to buy the shares if you don't have them already. And then on June 17th, you would get 20 cents from Alphabet for every share that you hold. As for the buyback authorization, that's $70 billion. It's the same as it was last year. And a buyback authorization doesn't mean that they're necessarily going to buy back $70 billion worth of their own shares. It means that they can, when they see opportunities in the market, they have that authorization coming from the board. So let's sort of dig into this a little bit more, how a dividend works, how a share buyback works, and why companies do them. So taking the dividend, first of all, you have to get approval from a board to do any of these things for the company. And basically, you get a piece of the action. That's all it means here, is that if you hold shares in a particular company, you will get, again, that set amount per quarter for every share that you hold. In the case of a buyback, and it's basically a little reward for holding those shares, and it's a sharing of the profits of the company. A buyback is a little bit different because those profits do not flow directly to you. It's more indirect. So when a company buys back shares, they reduce the total shares outstanding. Less supply of shares means it tends to boost the price, and it also tends to provide a bit of a floor underneath the shares. It's also a signal potentially from a company that it thinks its shares are well valued, and so that's why it's stepping into the market. In terms of specifically for Alphabet, what this means, we have to put this in context that a lot of big tech companies do not pay out dividends because they are viewed as growth companies. And as growth companies, they tend to reinvest their profits in the business. They don't pay them out to you because they're focused on growing, right? And we also learned that Alphabet saw a huge increase in CapEx, capital expenditures, in its first quarter because it was doing just that, investing in AI, but it's also now decided to pay out this money. So the fact that a big growth stock and tech company like Alphabet is now paying this out could also signal, according to some analysts, that they do see slowing growth ahead. So they need to offer you a little carrot in the form of this profit sharing perhaps to soften the blow of that potentially slowing growth. We don't know that. That's sort of the implication. So that's an interesting way to read into this. If you look at dividend yields of other large cap tech stocks, a lot of big cap tech does not necessarily pay out dividends here. Here's a few examples. NVIDIA and the dividend yield is effectively the amount that a company pays out in dividends annually divided by the stock price. NVIDIA's is very small because the stock price has gone up so much, but that company pays out 4 cents in quarterly dividends. Meta just announced the prior quarter its first ever dividend. Its dividend yield also relatively low, as is Apple's. You compare that with the S&P 500's dividend yield at about 1.4% and the Nasdaq 100, which is tech heavy, at about 0.9%. So these companies are paying out lower dividend yields, and there are higher dividend sectors like real estate and banks, for example, but that just gives you an idea of the landscape. All you ever wanted to know about dividends, and probably a little bit more, Brad.
It was the perfect amount. I mean, that's been a major question for a lot of investors over the course of this year. Do they even dividend, essentially, to summarize it? Because now, for some of these companies, it's a way to cozy up to the investor that looks at dividend-paying companies as a thematic strategy.
And one more thing I should mention, too. There are a lot of dividend strategies. They're usually called sort of equity income strategies because you're getting income from your investment. There are a lot of ETFs built around that. There are a lot of mutual funds built around that. And Bank of America noting today, in its note reacting to this, that per their Savita Subramanian, who's their portfolio strategist, that 40% of actively managed U.S. equity assets are equity income funds. They focus on those dividends. So this potentially means that Alphabet is now eligible for inclusion in those funds, and that could give a further boost to the shares.
Indeed. Julie, thanks for breaking this down for us. Very important information on dividends and buybacks there. We've heard a lot about that over the course of this earnings season. Also, we've heard a lot about inflation recently. Inflation remains stubborn. According to the Fed's preferred inflation gauge, the core personal consumption expenditures, known in your hood as PCE, core PCE, coming in at 2.8% in March on an annual basis versus the 2.7% that was expected. This is just the newest data point in a line of reports that have investors rethinking the timing of rate cuts. Only 30% of traders are pricing in that first rate cut in July, according to the CME FedWatch tool. You're seeing that data there and the probability. And stocks regaining some ground today after losses Thursday around a soft GDP reading. The S&P 500 and Nasdaq getting a big boost from tech earnings as well in the aftermarket trading activity and going into the pre-market, and now extended into today's activity. So for more on this and all of it, we turn to Brian Mulberry, who is the Zacks Investment Management Client Portfolio Manager. Great to have you here with us. Okay, so, I mean, it's been a whirlwind of a week with economic data, with data coming from companies reporting earnings, some of the Mag 7 companies in representation there. I mean, where is the clear prioritization that this market is giving this trove of information that's coming out at a fire hose type of speed?
Yeah, it's kind of interesting. We're having a bit of a repricing event that's happening in the market right now, and that is around higher for longer interest rates. As you just showed, the likelihood of rate cuts soon is declining, and that's because prices are staying very sticky. The other measure of inflation would be the core CPI, and what we're seeing lined up with that PCE number we got today is a month-over-month trend of just very sticky core prices, around 0.4 and 0.3%. all year long, and that just simply means that prices aren't going down. The Fed has told us their target is 2% inflation, and they don't really have enough information or data to truly decline what would be interest rates today. So the market has to reprice that. Think of it this way. At the beginning of the year, they were depending on 4 or 5 rate cuts, which means the year-end interest rate would be 4% or slightly less. Now they have to reprice future earnings against a 5% year-end interest rate, reflecting really only 1 or 2 rate cuts possible. And that's shifting the dynamic of how future earnings are going to be valued. It has twisted things this week to the point where when we saw Tesla actually come out with a miss on top line and bottom line earnings expectations, but the stock went up because they actually are showing better future growth over the next few quarters than what the market is offering right now. We can compare that to the S&P 500, where we started the year at about 11 or 12% earnings growth expected. that would be from $225 per share up to around $250. Now that's being dialed back under the weight of higher interest rates to only around $242 per share. So only a 7 or 8% earnings growth. So if Tesla is moving up earnings by 14 to 18%, which is what they expect, now you're getting double the growth in that stock than what you're getting from the overall market. And that's why the stock price went up. And so that's really just the dynamic that we're seeing, is that in this moment, the earnings in the current quarter aren't as important as the guidance over the next couple of quarters for investors right now.
You know, it's interesting. You mentioned Tesla. Tesla had once been firmly within the Magnificent Seven lexicon, and now, over the course of 2024, we've seen that Magnificent Seven conversation even shift into one of the big three or the Fantastic Four. We've heard a few different numbers tossed around, but ultimately here, it still does come back to a few things and the kind of intersection of roads here with the Fed's pathway and the policy there, as well as what the actual thematic play of generative AI looks like, and the investing and the amount that these companies are willing to invest, that's part of that intersection. So how does a shift in timing of rate cuts shift the portfolio strategies for those who have been over-indexed on the Mag 7 trade?
Well, the simple matter is higher interest rates make the value of future earnings go down. And so really it becomes a question of, are you properly managing costs and a higher interest rate environment at the same time? And we're seeing from these Magnificent Seven stocks a little bit different answer to those questions. To your point, at the intersection, what we're finding from Microsoft in particular is the cloud growth is up 23% in terms of revenue. Again, that's 3 times what you're getting from the market. And it also happens to be the most profitable business segment that Microsoft runs. So that leads to a better expectation of earnings growth on a net basis going forward. So again, the market is liking that. Google also a strong commitment now to shareholder value. 2 years in a row, $70 billion in share buybacks, reducing the amount of shares traded increases the price, and now they're sharing a dividend as well. So they're looking at it in a couple of different ways, where these companies that are in a very strong cash flow position are saying, we're going to dominate this, whether interest rates are higher or not. And we're starting to see some of the other businesses have to struggle in order to control costs and a higher cost of capital at the same time. And that's really going to be the dividing line for investors going forward. Know what you own, know why you own it, and really pay attention to those high quality stocks that have low levels of debt, good free cash flow metrics, and generally speaking, you might want to look for companies that have low short interest as well.
There are some folks that may be watching and saying, hey, you know, how do I, looking at what I'm invested in and knowing why I own it, how do I kind of remove emotion from a year where we've got, of course, elections that could impact the markets. We've got exogenous threats where we don't even know where that might come from, but that have a perhaps broader or pronounced near-term impact too. I mean, that impacts the strategy for a lot of portfolios that may be looking to retire soon. And so how do you kind of remove that fear, that emotion where you need to be strategic?
It's a great question, Brad. Thank you. And that's really those quality factors that I just described, those companies that have low debt exposure and good free cash flow metrics means they're able to pivot their business if they need to. If one of those exogenous events were to happen, they are actually in a better position to be able to shift their business if they needed to, and they have low levels of stress. So standard deviation would be a measure of that, meaning that if the market is moving in a particular way, typically to the downside, these types of companies have less downdraft in those moments of time, because this is where shareholders are going to go when they're looking for a safe haven. These higher quality companies, better profit structures, low levels of debt means they're less influenced by negative events that happen in the marketplace. So as a person that wants to make sure that they're protecting more of their assets to the downside rather than being concerned about double-digit growth, this is definitely where you'd want to go. And also the conversation earlier about dividends, remember that dividends over a long period of time have contributed as much as 40 to 60% of the total return in something like the S&P 500. So having a strong, stable base of high income paying stocks is also a great way to defend your portfolio against downside volatility.
Brian Mulberry, Zacks Investment Management Client Portfolio Manager. Brian, thanks so much for the context and insight here. Really appreciate it.
Thank you.
Certainly. Well, homebuyer demand taking a hit this week as mortgage rates stay above 7% for a second week in a row. The uptick in rates is certainly a sour note for potential home buyers looking to get in during the spring selling season. So, with sticky inflation pushing mortgage rates higher, should you rent an apartment or buy a house right now? Yahoo Finance's Danny Romero has the details. Hey, Danny.
Brad, consumers are dealing with high mortgage rates that are hovering above 7% and rent prices that are falling. So which market is better to pencil out here? Well, data from Realtor.com shows that the monthly median rent in February was about $1,700. That's $4 lower than in January. And that's enough to buy you a McDonald's Big Mac every month. Just a suggestion. The biggest price cuts in the rental market were for a studio apartment. The median price tag a month was about $1,400. 2-bedroom and 1-bedroom apartment prices also fell. But if you are considering in buying a home, data from Redfin shows that the median monthly payment on a home hit a record. It's about $2,800 a month. That's a 13% increase from the same period last year. And mortgage rates are partially to blame here. The average 30-year fixed mortgage rate is hovering above 7%, pushing homeownership out of reach. The other thing is that it has become clear that the Fed will keep these interest rates higher for longer. So the dream of the Federal Reserve's rate cut really looks a lot more distant now. Brad?
All right, Danny, thanks so much. Appreciate it. A lot to continue to monitor within that shelter part of the broader inflationary picture here. Shares separately of Chevron on the energy side here. Let's go and shift there. Shares of Chevron and Exxon sliding this morning after mixed reports. Both posted revenue declines from the prior year. But will the reports have an impact on your gas prices? That's the big question. To help us answer this question is our very own Inez Ferre. Hey, Inez.
Hey, Brad. Yeah, and let's take a look at the reasons for the profits declining for these big oil companies. Natural gas prices being down and refining margins were lower. The margin between the price of the feedstock, crude oil, for example, and the refined product. Remember that these big oil companies have numerous refineries. When we take a look at gasoline prices, though, they are sitting at $3.66 per gallon on a national average. From a week ago, that's down about 2 cents. So those prices may have peaked for the first half of the year. That's according to Tom Closa over at Opus when we look at these national averages. And then when we look at California, for example, one of the priciest states in the country, you're seeing that it's at $5.40 per gallon, last week at $5.45. So perhaps California also seeing its peak. That's for the first half of the year. And in fact, we may actually see some relief in some areas. But just when you thought that you were in the clear, a second wave of retail price hikes may be just around the corner in August. That's when we tend to see the prices go higher. Around September, we're seeing that the prices are peaking again and then decline into the end of the year. Look, OPEC Plus may decide to produce more oil in the second half of the year, but what analysts are saying is that that won't have an impact on any gasoline prices until really the last 100 days of the year, Brad.
All right, thanks so much, Inez. Keeping tabs on all things oil, gas, and energy here. Let's do a quick check of the markets here. We're just a little over 90 minutes into the start of trade. This market check is sponsored by Tasty Trade. Taking a look at the Dow, the S&P 500, and the Nasdaq. We've got green across the screen right now. The Dow is up by about 0.2% off of its session highs, but still holding on to gains. The S&P 500 up nearly 1%, and the Nasdaq up nearly 2%, 311 points in positive territory. Coming up, Intel shares taking a hit today after its first quarter earnings report. We speak with CEO Pat Gelsinger to hear more about the future of the company's foundry business and its place in the AI arms race. That is coming up next. There you see Pat. Pat, stick around. We're coming to you in a hot second.
Intel reported strong first quarter earnings on Thursday after the closing bell, but lots of focus by investors on the company's outlook, which are putting some pressure on shares of Intel today. Let's get right to Intel CEO Pat Gelsinger. Pat, thanks for always making time with us. I know these are busy days. You're always traveling the country, but thank you as always. Let's talk a little bit about that outlook, and then we'll go back to the quarter a little bit. Tell us and explain to us some of the things you're seeing that warranted that little bit more cautious second quarter guidance than the street was expecting.
Yeah, thanks, Ozzy. And yeah, coming off a strong Q1, and we see a lot of progress in the second half of the year, but a little bit more tepid in Q2. And some of that was strength of Q1, right? We were able to see a little bit better earnings than we expected in Q1. So some of that was there. But overall, the market is a little bit weaker, even as everybody is projecting the second half being much stronger. So that outlook, a little bit of reaction for it. But from our view, hey, a first half, second half story similar to what we saw in 23 is what we're pretending. And we have a lot of great things happening in the second half of the year. So we feel very comfortable with the outlook that we had. Very proud that we had a good, solid execution in the first quarter of the year, and the long-term strategy is coming together as we would expect. We got a lot done in the first quarter, a lot to build on for the future.
Pat, that weakness, let's look at it from two perspectives. Is it PC demand, or is it demand from big companies or enterprises?
I'll say overall, the market was a little bit weaker as we see it shaping up in Q2, but returning in the second half of the year. So it's a bit of market weakness. We also saw some unique issues. The AI PC is hot, and we weren't able to satisfy all of the demand requests that we've got. So we're meeting our commitments, but we're not hitting all of the upside requests. So a little bit of our own opportunity there that we weren't able to fully realize yet, that we're working hard to satisfy those market requests. But overall, we also have businesses that are coming out of inventory challenges as well. We saw that with Mobileye, our FPGA business, our NEX business. So as they finish their inventory improvements that we see just happening very naturally in those businesses, that the second half will be markedly better as well. So unique inventory, some in the market, and some of our own catching up to accelerated demand, particularly in the hot AI PC category.
I haven't heard you say that before, hot AI PC demand. Now, obviously, these products are just hitting the market now. Are you still looking for 40 million shipments this year?
Yeah, I'm driving our team super aggressively, and every day the market is reinforcing this enthusiasm for the category, and we believe that we can go over 40 million units this year. I'm going to push our team super aggressively. Obviously, the Core Ultra is the defining product for the AI PC category. We'll be introducing our second generation product, what's codenamed Lunar Lake and Arrow Lake, later this year. So as competitors start to show up with their first, we're delivering a second generation. Our third generation product that we call Panther Lake is our first on 18A, the next generation process technology, and that'll be coming forward next year. So we really have a strong roadmap lined up. Lots of ISVs, compelling use case across, collaboration applications, developer applications, training. And I'm even showing off how we're using the AI PC in our own factories for improved yield and performance management of our factories. So really exciting period of time. I think the biggest cycle of PC surge is just getting started with the AI PC. And of course, a Windows refresh later this year will be helpful for the category as well.
Pat, every time I talk to you, I'm always blown away by how much there's just going on inside of Intel right now. Are all these new products that we've talked about today and then over the past year, are they all on schedule for this year to release on time and customers will get them?
Yeah, one of the things I'm really proud about over the 3 years of rebuilding Intel is we've gone from a period where customers couldn't trust us to hit our product schedules, and now we're hitting the front end of our best case schedules with customers pretty much across the board. And that is just really rebuilding their confidence. And for instance, we just announced Sierra Forest, our first Xeon 6 product with our very efficient, power performant cores as part of it. And that was the best case schedule that we delivered. The first product on Intel 3 coming into the marketplace, and the first time in a decade that the U.S. has been manufacturing the most leading edge technology in the world. So products like that are rebuilding confidence. A stronger product line allows us to stabilize and regain market share. So overall, we're doing what we said we would, and I'm proud of the execution of our team in making that happen.
Pat, very early this morning, I was taping my new podcast, Opening Bid, and the guest that we had on, he really reminded me that over time, stocks do in fact go up, and it's all about investing for the long term. And I think a lot of investments you're putting into your business today are for the long term. So by 2030, what does Intel actually look like?
Well, by 2030, we believe that we will become the leading AI systems foundry and the second largest foundry in the world. A business that today, as you see in the numbers, is tiny today for external foundry, but we see this becoming a very large capability. And consistent with the theme that we've talked about, the world needs geographically balanced, trusted, sustainable supply chains. And we're going to make that happen in the semiconductor segment. We saw the CHIPS Act coming forward this last quarter as really putting that stamp on, the national champion Intel and what we're doing with the total of the $45 billion grant package that was there, the milestones that we're hitting in our own technology development, and these new products are coming to life, showing that we're hitting the technical and manufacturing milestones to make those real. And as those products and technologies ramp, the financials, as I would like to say, every quarter for my foundry business gets better from now to the end of the decade. Revenues improve, margins improve, profitability will be growing. This will just be that every quarter we just see that progress as we go through literally the rest of the decade. So I'm very confident that we're doing what we said we would, maybe the most important strategic turnaround in corporate history, and we are on track to make that happen.
Pat, lastly, before I go, like I mentioned, you have a lot going on at Intel. From a leadership perspective, how do you know where to spend or devote most of your time? One minute I see you hanging out with the president, and now you're talking to me. You had the earnings call last night. What's your days looking like?
Well, obviously, to me, spending time with customers and my engineering and manufacturing teams, those are, to me, the most critical things that I do. Right? Making sure that we're rebuilding that customer relationship, our products are hitting the needs. And then, I'm a geek at heart, as you know, Brian, and spending time with the engineers, making sure we're rebuilding the execution machine and the technology roadmaps. But as any CEO, you have many other hats to wear, whether that's financial hat, whether that's the press and relationship hat, such as this one, whether that's the government affairs hat that you see me wear. But the ones that I want to spend the vast majority of my time are the customer hat and the internal facing hat to make sure we're rebuilding this iconic company, a critical role, for the nation, the industry, and the world. And we are on that every day.
Well, thanks for putting on your Yahoo Finance hat as always, Pat, for one of these. Pat Gelsinger, always very busy, Intel CEO. Have a good week, and we'll talk to you soon, sir.
Thanks so much, Sazi.
All right, be good. All right, before we head to break, I want to tell you about Yahoo Finance's brand new podcast, Opening Bid, hosted by yours truly. We have new episodes every Monday and Friday morning at 8 a.m. Eastern Standard Time across platforms. This morning, I was able to sit down with Keith Lerner, Truist Co-Chief Investment Officer and Chief Market Strategist, as well as our very own Inez Ferre. Here's a little preview.
Even as a strategist, it's great to be able to say, we got the bottom or we got the top. Our process, what we try to do is
because I used to be an analyst. I loved making that big call. Like, ooh, I just picked that stock. I'm jacked up. I want to get on financial TV.
Yeah, and listen, it's you got to be careful because, what's more important, trying to be cute to get the exact bottom or saying, hey, the risk reward is more improved, and don't worry to get the last 1 or 2%. And listen, as a strategist, you have your good calls and bad calls. Actually, one of my best calls. Can I?
No, of course.
Okay,
we're here to talk. We're here to talk.
At the October low, we wrote the note that day as the market was breaking down those panics, saying this. We think this is a buying opportunity, and we were within a 1% or 2% of the low. So we hit that.
Nice call.
But then I remember also in 2008, which I was early in my career. You said, how do I get 2 titles? Well,
so you got to make big calls. That's how you get 2 titles.
No one was watching anyway, so who cared?
Gold has had a record run this year, and silver hasn't been far behind. Silver outpacing gold, but still shy of its highs. That's thanks to traders rethinking their rate cut expectations. While silver is down from its highs, our next guest is upgrading his forecast for the metal. Michael Scheu, who is the Deutsche Bank research analyst, is here with more. So, Michael, take us into your thesis here on silver.
Okay, so silver is kind of it's bipolar. It has two different personalities, right? One is as gearing to the global manufacturing cycle, and two is as a sensitivity to gold, usually with a beta that's above 1. And right now, with the global manufacturing cycle not really doing a whole lot, I think in the U.S. certainly we've kind of troughed in a mid-cycle slowdown in over the course of 22 and into the mid-2023, and now we're kind of in a very shallow recovery from that. But I think broad picture on the manufacturing cycle, it's not a very strong input to the silver price at the moment. There certainly are historical instances when it can be, most notably in the lead up into a recession and coming out of a recession from that recovery, can be very stark in terms of their impact on silver. But right now, it seems to be the sensitivity that gold that's really dominating silver at the moment, and that has given us a bit more of a lift to where we expect silver can end up. And so I think a lot of the story for silver at the moment does come back to gold, in fact.
It's so interesting. As we're continuing to take a look at both silver and gold and some of the kind of price movement that we've been tracking, not just over the course of this week, but over the course of this year and the correlation that you were talking about just a moment ago, I wonder from this point forward what the outlook looks like for the rest of this year. What is going to be the catalyst that really pushes either of these commodities back towards all-time highs?
Yeah, and to recall, we're really not that far off those nominal all-time highs. And I think what we're seeing at the moment is kind of the market taking stock, really, after what we had in March and April, which is, to all intents and purposes, a kind of historic investment inflow into gold of historic size, really, that we could compare with what happened in 2013 in terms of the outflow in gold as the Fed was dialing down the pace of bond buying, and then contrasting that with 2022, the big boost in central bank buying in the second half of the year that really helped gold diverge from fundamental fair value models. And so the buying that we've seen since March and April has been, easily of a comparable scale to what we saw in 2013 in terms of selling, and then 2022 in terms of central bank buying. So, that's a huge slug of investment demand that's just come through. And the market's now thinking, how much of a correction do we get? Our thesis has been that the correction is going to be relatively modest in gold because investors around the world came into this year with a bullish bias. It just wasn't, I think the acceleration in demand that we had in March and April, that pace of acceleration and the timing of it was just not necessarily foreseen. And so I think any correction is going to see healthy investment demand to pick up from that correction as we go through the year, and as a Fed easing cycle remains on the cards, even if that's been dialed back and pushed back by a massive amount. I think the bullish bias over kind of a 1 to 2 to 3 year view is still going to remain to the upside for gold. And so it's a matter of, silver playing along with that for the most part, and even potentially getting a little bit of uplift if the manufacturing cycle does improve moderately, which it seems like it is.
Certainly. And Michael, you started to touch on exactly what I was just about to ask you, which is how much of what we're seeing in gold and silver is directly correlated to the pushing out of some of those rate cuts, or at least the probability of those rate cuts from the Fed as they kind of continue along their own policy pathway and looking at inflation continuing to remain hot and not having the kind of data, at least in the trend that they're looking for to firmly cut at this juncture?
Yeah, I think we came into the year with the expectation that it would be all about the Fed, quote unquote, for precious metals. And in the end, it really has been, but not quite in the way that we had expected. I think that if you had told us that we had gotten the amount of dialing back of Fed easing that we had, we'd certainly have been quite surprised to see gold where it is at the moment. And so I think the overriding influence from the Fed cycle is that investors can still look forward to and are still looking forward to an easing cycle. It's less important the timing and the depth of that cycle than the fact that that cycle is coming, rather than at various points when some people thought that we would be getting a further hiking cycle or further significant hiking cycle. And as long as that doesn't seem to be coming to pass, I think that investors will maintain a bullish bias on the precious as a whole.
Michael, thanks so much for joining us here, breaking down gold, silver, the commodities landscape. Michael Shoy, who is the Deutsche Bank research analyst. Appreciate it.
Thank you.
Thanks. Coming up, everyone, the key things that you should consider before buying a home. We've got that for you next. Housing market might just be too legit to quit here. Pending home sales, which measures the volume of signed real estate contracts in a given month, it jumped unexpectedly in March, up 3.4%, even with mortgage rates continuing to rise over 7% here. More people are out there. They're putting in offers on homes. So if you are in the market for a new home, what should you be taking into consideration about the market right now? Joining me now, and this is Mariana Nero, who is the Sirhan, Florida founding agent. Great to have you on with us, and thanks so much for taking the time. I took a look at some of your listings, not shabby at all, and of course, the Florida market booming, especially post-COVID. So all of these things considered, what are the top considerations that people going into this spring buying season should be keeping in mind?
Okay, Brad, thank you for having me here. Definitely they need to define if they're going to buy cash or if they need a finance. If they need finance, they need to get ready before searching for properties and putting offers. With the pre-approval loan from their lender, with that letter, they not only they're gonna understand better how much they can afford. Maybe they can afford more than they think, or maybe they can afford less. So then they can filter and do a better search. And with that pre-approval letter, they're gonna have a lot more power while putting an offer and negotiating a property.
I wonder what you're seeing in the negotiations right now, especially in the market that you're within, and where you're seeing buyers kind of come in from. I mean, it's probably not first-time home buyers based on some of the listing prices that I had seen for your listings, but at the end of the day, there's a lot of just conversation about where they're trying to make sure that they're negotiating properly for themselves.
Yes, we see buyers from all over, especially I'm in Florida, down in Florida. We have a lot of people, a lot of Latins, but we have a lot of the US new buyers. We had a surpassed demand from the last 12, 24 months from buyers that didn't pull the trigger that we see now jumping to the market. And that's why we see the home sales increased in the last few months, especially this year.
Just lastly here, before we let you go, where do you see the market moving as you kind of look out into the rest of the year? A lot of potential buyers that are still on the sidelines, just waiting for potential rate cuts.
Yes, don't wait for the interest rates to start to drop because prices will skyrocket. What I tell everyone is that every half a point in difference in the rate is only $33 monthly with principal and interest in every $100 that you borrow. So it's not a lot. It's better for you to just negotiate while your prices are still low because prices will jump once the interest rate starts to drop. And that's the trend.
All right, Mariana Nero, Sirhan, Florida, founding agent. Thank you so much for joining us. Tell Ryan I say hello.
Okay, thank you. Thank you, Ryan.
Will do. All right, you may be ready to break ground on a home renovation project or a DIY project, but is your wallet ready? No matter how big or small the project, the right credit card can help your finances here. And here with more, we've got Yahoo Finance's Kendall Little. Kendall, great to see you. So how do you determine the right card for that DIY job that you're about to start on?
Yeah, so there's a few things that you want to consider when you're comparing different cards for a home improvement project. One, of course, is rewards. And some cards actually cater to this with cash back or other rewards on home improvement purchases. This can look like up to 5% back on that spending, up to certain limits, whether that's $500 every month or $1,500 every quarter. So you can really earn rewards on the money that you're spending, those extra expenses that come from your project. The second one is going to be a 0% APR offer. These introductory 0% APRs may last for anywhere from 12, 15, 18 months. And that really helps you not owe any interest on the purchases that you make over that period. Now, at the end of the intro period, any balance that you have remaining is going to start accruing interest. So it's important to pay it off over that period, but it does add some flexibility for you. And lastly, a lot of people might be interested in retail cards from home improvement stores. And these cards typically will offer either savings on your purchase or special financing options. But one thing to keep in mind is if you opt into a special financing plan with a retail card, they usually carry what's called deferred interest. So instead of just accruing interest at the end of the period for a remaining balance, you could actually take on interest going all the way back to your purchase. So you want to make sure that you really pay off that balance by the time your period ends.
So what are the pros and cons of using a credit card for some of these home improvement projects as well?
So the biggest pro is really going to be the potential rewards, savings, flexibility. If you want to get cash back or miles or points on your purchase, a credit card is the best way to do that, especially because you're probably spending more over the course of this project. And even after the project ends, those rewards cards can offer savings on your regular purchases going forward. And then a 0% APR, like we talked about, can really add some flexibility for your spending and help you buy some time to pay off those bigger purchases so you're not adding interest to the cost. But that also leads to one of the biggest cons, like any credit card purchase, which is going to be the potential added cost of interest. So you really want to make sure that you're reading the terms of any agreement that you sign up for and that you understand exactly what the consequences are of not paying off your balance within the plan that you sign up for.
Some great tips, great reminders as well. Kendall Little, thanks so much.
Thanks.
Absolutely. Everyone, we've got much more on wealth after this short break. Well, on social media, a meme is a funny image or a video that's widely spread around the internet. But in the world of finance, it's a little bit different. Meme stocks are recognizable when shares of a company gain viral popularity and then witness massive price swings. In short, you might think of GameStop and AMC. They're among some of the meme stocks that investors have made popular in the past by forcing short squeezes. That, different definition for a different day for you. Now, this is just one of the many ways investors can get into the stock market, but our next guest says that you should avoid meme stocks as your introduction at all costs here. For more on this, I'm joined by Todd Walsh, who's the Alpha Cubed Investments CEO and author of Exponential Gains here. Todd, thanks so much for taking some time here. All right, you're advising against this being your entry point, meme stocks being the first trade that you make. Why is that?
Well, hey, Brad, thanks for having me on. You know, we have a generation of investors around and under 30 that think in stocks like meme stocks, AMC, game stocks are investing, when really they're speculation. We saw a lot of investors beyond Gen Z and Gen X chase a lot of wild stocks in the pandemic. We saw Peloton, we saw Zoom go up and then drop 90%. People need to have a foundation underneath what they're doing, an investment process that kind of weeds out the speculation and brings them more into investing. So that's kind of what the book's about.
Certainly, and I guess, you know, as we're thinking about what the propensity is for certain thematic plays, especially among younger investors, what are you witnessing, what are you seeing, and where does it hold value versus where there should be a little bit more kicking of the tires on the fundamentals?
So we need to get away from the idea of making a big score and get a process in place that looks at revenues and earnings. If there aren't revenues and earnings, and if they aren't growing pretty well and appreciably, then we're probably speculating. And if we can educate people in general about the difference between speculating and investing, I think we're going to go a long way to creating a generation of successful investors.
Is DJT in a meme stock phase right now?
DJT, which one's DJT?
It's the Trump Social
sorry.
Truth Social,
Yes.
excuse me.
Yes. Yeah. Sorry about that. It's only an election year. Who's thinking about this stuff yet, right? It's a little speculative here. I mean, let's be honest. There aren't the revenues to back it up. The first thing we do when we look at any stock is look at what are the revenues and are they projected to grow? Have they been growing? What are the actual earnings? Revenues is one thing, right? But we got to bring some money home and make some money on these investments. So we need to look at the earnings. And a lot of these stocks, there's a lot of hype around them. You mentioned DJT. We're still running into younger investors who are saying, you know, once my AMC gets back to 40, I'm going to sell it. And that may not happen. So by getting a process in place, which is exactly what the book is about, create a process to separate the difference between speculating and investing. So the DJT you mentioned, you can speculate all you want as long as you understand that when you speculate, you might lose a lot or all of your investment. We're all adults, and if we, choose to lose a little bit of money, that's fine. You can make a lot of money on some of these things too. But the core of what you're doing, especially for younger people, has to be process-based and has to be backed by good revenues and good earnings. Otherwise, you're just taking a big risk.
Todd Walsh, Alpha Cubed Investments CEO. Todd, thanks so much for taking the time here on the show with us today. Appreciate it.
Thanks, Brad.
Absolutely. Everyone, that's it for now. I'm Brad Smith. Thanks for watching Wealth on Yahoo Finance. We'll see you next week.